Welcome back. In lesson 2, we will be talking about what the IRS calls provisional income and how that number determines how much of your Social Security benefits each year are taxed. However, before we dive into that, let me share with you a brief history of how Social Security benefits have been taxed in the past. In 1940, the first Social Security benefits started as a result of Franklin D. Roosevelt signing the Social Security Act of 1935. These benefits were intended to be a tax-free income benefit for retirees starting at the age of 65, and it was not until 1984 that up to 50% of those benefits became taxable for people who had income above a certain amount or tier. And it was shortly after, in 1993, that an additional tax tier was added so that up to 85% of benefits could potentially be taxed. I know, not exciting. Essentially, it used to be a tax-free benefit. It was intended to be a tax-free benefit, but over the course of time, Congress has decided that they needed to tax some of your income. Provisional income itself is determined by a simple formula that the IRS calls the provisional income formula. You can see from this chart that it seems pretty simple. Modified adjusted gross income, or MAGI, plus half of your Social Security benefits, plus any tax-exempt interest. However, let's slowly walk through that so it's a little bit easier to understand. MAGI is essentially all of your income except your Social Security income. That's why in this next step, we add half of your Social Security benefits to that MAGI. And then finally, any tax-exempt interest. This might be any municipal bond interest that you've earned that initially is not taxed, but it's considered towards this income formula. Once you've calculated your provisional income amount, you can then use this chart to determine how much of your Social Security benefits are subject to tax. On the left-hand side, you can see this graph for married filers, and you can see that for a provisional income of under $32,000, 0% of your Social Security would be subject to income tax. $32,000 to $44,000, 50% of it would be taxed, and over $44,000, up to 85% of your Social Security benefits would be taxed. You can see the single filer rates on the other side. As you know, I love to relate this back to an example so we can really internalize what this means for us. So let's go back to the example of Bill and Janet that we introduced earlier on in this course. You can see here that we've captured Bill and Janet's provisional income starting at their age 70 and a half, their RMD years. They had income of $30,000 from their pension, $10,000 from their rental income, and $41,000 from their required minimum distribution. That's their MAGI. If we then add $15,000, which is half of their Social Security benefits, you'll get a full provisional income amount of $96,000 in that year. And as you can see, $96,000 is greater than $44,000, hence 85% of their Social Security benefits were taxed. Hopefully this lesson gives you a good idea of how to determine how much of your Social Security benefits are taxed. And ideally, throughout the rest of this course, the goal should be answering the question, how do we reduce how much of our Social Security is going to be taxed? We'll cover that a little bit in this next lesson, and by the end of this section, we'll be able to use a financial calculator or a 1040 calculator to know with a little bit more definition how much of our Social Security benefits are taxed. We'll see you in the next lesson.